Hello, everyone, and welcome back to Your Finance TV. A little abnormal as we're recording the musings on a Monday here with Jay Pelosky, but how are you, Jay?
I'm well, Scott. Yeah, a little bit change of pace, but we're flexible, right? We're market guys. Got to be.
Exactly, you have to be flexible. Your musings this week, though, listen, the title Humdrum is underrated. Sort of got me a little bit bamboozled. I don't really know what to do with that one. Like it's Humdrum, sort of sounds like a horse's name, to be honest. But run me through the title.
Yeah, it. I give a hat tip to Bloomberg because that's where I saw the word humdrum. They used it in reference to Chair Powell's Humphrey Hawkins testimony. And humdrum means dull, monotonous, lacking in variety or excitement. And so, A, I thought it was kind of a cool word, right? You don't see it very often. And B, in a way, it really reinforces one of our 4 for 24 macro surprises, namely number 3, return to stability, right? And that's been a big theme of ours. Remember, we did our 2024 outlook back in late October, early November. So already, 5 months ago or more. And I think that thesis is playing out. And it's a perfect example. We have the Fed chair speaking for 2 days. Usually markets are on edge the last couple of years, given inflation spike and rate hikes, et cetera. But lo, here we are. And it was a nothing burger. And then at the same time, you had the ECB meet. And there again, same thing, virtually no market reaction because the market has already absorbed the fact that the monetary policy or the Fed, ECB, et cetera, are effectively not the most important game, right? And we wrote about that a few weeks ago in Handoff, where we talked about the shift from markets depending on rate cut expectations to being dependent much more on growth in earnings. And that's really been an important transition and one that's pretty normal. First part of any kind of bull market move is multiple expansion, right? Market moves before the economy picks up and earnings pick up. And then the second phase, where we are today, is economic recovery, earnings recovery, et cetera. And so it really kind of struck me that humdrum was a good word to kind of reinforce this return to stability and a little bit of normality in the markets, which we think we're in the beginning of a multi-year phase of a more kind of stable macro backdrop.
Well, let's dig a little bit more into you mentioned there the ECB and Powell and rate cuts and so forth. And like, listen, for me, who wasn't really involved in the markets last week, it seemed like that was a little bit more of a highlight. Does that really fall into that humdrum nature of last week?
Well, even in humdrum or quiet markets, there are things to pay attention to, right? I mean, that's the nature of the beast, and we highlight a couple. First off, the rate cutting cycle is one that we've been talking about for some time. We believe it's being led by the emerging markets. The Fed and ECB, et cetera, are kind of late to the game. Many EM markets, Poland, Brazil, Chile, Colombia, et cetera, started cutting rates last year. So that's an important component to our view of stability going forward. We have rate cuts that should be supportive of risk assets. We have global liquidity. We expect that to continue to be supportive for risk assets, particularly on a global basis when you think about the PBOC in China and the Bank of Japan continuing to provide liquidity. And then you have kind of a double-barreled, double-digit back-to-back years of EPS growth and stock buyback. So let's unpack that a little bit because I think it's pretty important. As we touched on a few minutes ago, our thesis is that we've handed off to economic recovery and earnings growth to drive stock markets, particularly in the U.S., higher. And so 2024 and 2025 earnings are forecast to be up double digits in both years. That's supportive of our main thesis, this return to stability in several years of upside opportunity. And now most recently, Goldman came out with a report and talked about how they expect to see stock buybacks in up double digits this year and next, and forecast $1 trillion, Scott, of stock buybacks next year in the US. So we put all those things together, and it just kind of reinforces stability. It reinforces upside. It reinforces risk appetite, notwithstanding the fact that we've had a very strong move over the last, 20 weeks or something. The S&P is up 19 out of 20 or 18 out of 19. So we've had a big move. Pullbacks would not be a surprise, but importantly, there are several factors lining up to support risk assets both this year and next.
Okay, well, so taking all of that in, and you've pulled some great stats out there. Like, I believe you've also looked at your two models and done a review on that. Like, how has all of this information impacted that side of it?
Yeah, well, we did do that exactly. But before we get there, I also want to just touch on Japan and China, which are two important markets. In Japan, we want to note that it looks increasingly like the Bank of Japan is going to move off its negative interest rate policy and yield curve control policy, potentially as soon as in the next, excuse me, in the next couple of weeks, given that inflation is coming in higher than expected, and also their spring wage negotiations, which is a big driver. The main union is asking for a pay raise of about 6% for its workers. And so if that gets accepted, that's going to be the catalyst that will move the Bank of Japan off its negative interest rate policy. And we're already seeing markets react with the yen strengthening fairly considerably and the dollar weakening. And we're going to get to that dollar in a minute. The other point on China is just kind of a hat tip to our tripolar world thesis and what we wrote about in the monthly, the manifestation of the tripolar world. We did note that China is moving ahead with its third semiconductor fund, raising roughly $30 billion to support semiconductor development within China. And this just goes to our thesis that semiconductor AI is just the latest example of a big trend that is reinforcing the regional integration in Asia, Europe, and the Americas. And that fund is just another illustration of the spending, the investing, the criticality of the need to be a player in the semiconductor and AI space for each region. So that was, I just want to mention that as an aside, but absolutely, as you say, our process has been and continues to be, you're right, excuse me, I'm still getting over a bad cough. We write our musings, then we write the monthly, and then the next week after that, we do our model portfolio update. Remember, we have our global multi-asset model and our TPW20 thematic model. And, the interesting thing is that when we look, part of our process is to look at every chart for every position we hold, all potential positions, all benchmark positions. And it really gives us some insight into how the markets are behaving. And I just note a couple of things. First is that the markets are clearly broadening out, not only within the US, and there's been a lot of talk about that. And we've been very focused on not only tech, but also the cyclical segments like home builders, like transports, like industrials, all of which are breaking out. More importantly, other parts of the world are participating. And we noted that ACWI ex-US is actually outperforming the S&P over the last month. That's not something you hear very much about. And then in addition, and in a similar fashion, we note that small caps are outperforming both the S&P and the NASDAQ over the last month. So amidst all the publicity about the Magnificent Seven, there's a lot more going on under the hood, so to speak. And we see it in our models because we hold a lot of that other stuff as well as tech exposure. For example, we hold small caps, and we're big believers that if our return to stability thesis is correct, if we have a multi-year runway going forward, if we're early cycle in a global economic recovery, then risk assets have further to go. And the laggards, like small caps, like non-US, are going to catch up and perform. And so we want to, as we said a couple of weeks ago, we want to be kind of with a barbell. We want to be in the leaders, like tech, and we want to be in the laggards, like emerging markets and like small caps in the US. And let me just finish on that emerging market point, because the thing we're watching carefully now is the dollar. And the dollar is weakening as the Fed gets ready to cut rates, right? As it becomes clear that other parts of the world are starting to pick up. We think the dollar is rolling over. We think the dollar, if you look at DXY as the dollar, we think the high for the year is probably already in, even though we're just in the middle of March. And this could be the catalyst to really drive flows into emerging markets and into commodities, right? And one of our big bets is we're overweight commodities and underweight fixed income in our global multi-asset model, with the thesis being that as we move forward into a global recovery, we should start to see commodity demand pick up. And commodities, again, surprising to many, are performing in line with ACWI, both up about 6% per year. And the thing we're really watching within commodities right now is copper. And we see signs that copper is breaking out, particularly in COPX, which is our copper miner position. And as that breaks out, we could see an environment that reminds us a lot of uranium at the turn of the year, where you had supply issues meet a sense of renewed demand, which in copper's case, we think will be that economic recovery starting to percolate in people's minds, that you could have a price spike, much as we did in uranium, where it went up 25% in 5 weeks. We think something like that could happen in the next month or two in the copper space, driven in part by that dollar weakness and a sense that the global economy is picking up, running into supply issues within the copper industry. And so that's one we're paying special attention to as we move forward.
Okay, Jay, listen, there's a lot of good things you pointed out here for the viewers, okay? Now, before we wrap all of this up, and so that people can look forward to different things they can invest in, what are your two standout areas from this breakdown?
Well, I think when we look at the areas for real upside opportunity, there are two. One is China, and the other is climate. So China obviously has not participated at all. Everyone's pretty much aware of that, though it does look as if a bottoming process is in. And we just highlight KWEB in the musings. And we give an illustration that KWEB today trades about 25 bucks. It could double to 50 and then double again to 100 before it gets to its 2021 high, which was around $101. And so it's really hard to find that kind of upside in the US right now, right? The US is already above its 2021 high. If you look at the S&P, we're at new all-time highs, certainly new all-time highs for tech in the United States. China tech, which has to develop for China to develop, as we just touched on, can double and double again to get to that 2021 high. So that's an example of the upside there. And then the other is climate, which, as we touched on, many times over the last 6 to 9 months, has been a real tough area to invest in. Notwithstanding the fact that increasing amounts of renewable energy are being made available, it's been a very tough place for companies to make money, in part because of China competition in things like solar and wind, et cetera. So we see a similar opportunity in climate, in parts of climate, should we have that runway, right? So a lot on the climate side depends on that continued smooth multi-year path that should allow for kind of some rebalancing between the ever increasing amount of renewable energy being brought to the grid and companies being able to make money in that process. And so that's another area where it's not quite as visible, the catalyst, but it's a space we believe in, and it's a space we continue to participate in, both in our global multi-asset model, but especially in our TBW20 thematic model. About 30% of that is invested in climate-specific areas of opportunity. And so we watch that space carefully as well.
Jay, listen, thank you so much for this breakdown. The viewers are going to love this one. You have a great week, and we'll be catching up with you again soon, okay?
Absolutely. See you on Friday.
And for everyone else out there, good luck investing.